Two ways to deal with market pullbacks in this week's fastest 4 minutes in finance. Hello and thanks for joining us for this week's segment. I'm Scott Inman. The stock market sell-off that began 3 weeks ago intensified early this week as the S&P 500 index fell nearly 10% off its all-time high Tuesday before closing above the low. Stocks are suffering the most severe pullback since the second half of 2023 when the S&P 500 fell 10.6%. Now, the difference between then and now is that the sharp sell-off has happened much more quickly. In 2023, the correction played out over 3 months instead of 3 weeks. And this can have a much greater impact on an investor's mindset. So we want to give you this week 2 ways to deal with that. First, stay invested. No matter how much fear sets in that you need to jump off the roller coaster, history tells us it would be a bad idea. This kind of volatility is normal. According to LPL research, pullbacks of 5 to 10% happen on average 3 times per year. Even a 10% correction is common, happening on average once every year. The maximum drawdown for the S&P has averaged about 14% per year since 1980. And in years of positive returns, the average maximum drawdown is still 11%. We didn't get one in 2024, but we got one in 2023. This is the price we pay for long-term growth. And it may pay a bigger price if we jump ship. The S&P 500 has gained an average of 9.8% annually since 1990. If you miss the best day of each year, your return drops to 6.1%. Miss the 2 best days of each year, and your return would have been just 3%. The biggest up days tend to happen when the index is below its 200-day moving average. And last, since 1980, after corrections, the index has been higher on average 13.1% 3 months later, with gains 92% of the time. That's off the low, which we won't know for a while when that is. Volatility is the price we pay for long-term growth. The second way to deal with market pullbacks is to be prepared with a diversified portfolio. Investors shouldn't be all in on the S&P 500. Of course, the index cannot be directly invested into, but lots of investors put everything they have into index funds that track the performance of the index. The S&P is a weighted index, meaning the largest companies in the index can carry it and also drag it down. Those larger companies have been hit hard in the past 3 weeks. A diversified portfolio spreading equity risk along multiple sectors and styles and adding in bonds, alternatives, and even cash can dampen volatility. It can also create more wealth. Take a look at this chart. This tracks a $1 million diversified portfolio in black compared to $1 million tracking the S&P 500 index in green from 1990 to 2020. You can see the diversified portfolio grew to $3.5 million versus $3.2 million in the S&P 500. The key reason, it didn't take the severe dips when the bear market came and took less time to recover because of it. Now, past performance is no guarantee of future results, but the bottom line, preparing your portfolio before the market volatility comes and weathering the storm during it is the best way to achieve your long-term goals. Thanks for watching. Want to become smarter financially in 4 minutes or less? Sign up at fastest4.com to get insights and updates like this delivered to your inbox weekly.